Hello, everybody. This is the accounting professor, and welcome to today. Right over here, what we're going to be going through is doing a comprehensive multi-year accounts receivable question. This will hopefully help us cement everything we've been learning about accounts receivable. I am the accounting professor, Bennett Tchaikovsky, or accounting professor, Bennett Tchaikovsky. This presentation is copyright 2008 to 2024 by myself. All rights are reserved. Any redistribution is expressly prohibited without my prior written permission. The opinions expressed herein are those of myself and do not represent those of Irvine Valley College or the South Orange County Community College District. So let's get to it. Okay. So when we come over here, we have during 2032, Oilers Inc. started business and had the following transactions during the year. So as we can kind of go through and see, they had all of these different items that are kind of happening. And then we see 2033, and then we see 2034. So when we're kind of going through and looking at these different types of questions, what this kind of question really represents is a place where we really want to kind of go through and be using our T accounts. And the T accounts, obviously, why do I use T accounts? Because in my opinion, it's one of the best ways to kind of learn accounting. Assets equals liabilities plus owner's equity, expenses, revenue, debit, and credit. Now, for these particular problems, you may only need to increase one side of the balance sheet equation. However, to make this a little bit easier upon ourselves, we'll go ahead and use T accounts, basically use them as needed throughout the problems that we're kind of coming through and taking a look at. So we can just give me a moment. I'll make this a little bit less painful for you. And just to kind of as a reminder, in terms of what we're trying to go through and do when it comes to accounts receivable. Accounts receivable is basically, it is an asset on our, it's a current asset on our classified balance sheet. And it basically arises when we have a credit sale, meaning that we as a company have decided to say, this is a good customer. We can do business with them. We're okay with them paying with us within a period of time. And so, but when we're showing, we're not perfect. When we're showing the accounts receivable on the balance sheet, it's going to be the accounts receivable less our allowance for doubtful accounts. And this is a contra asset account. And what this really means is that what do we go through and expect to collect? And this is going to be accounts receivable net. And this is really basically the AR less the ADA. So if I look at a financial statement of a publicly traded company, and I'm always, for this one, I've found it once. I keep going back to the same well, so to speak. I'm going to go ahead and look over here. And by the way, you'll always will see companies change their disclosures, which is just kind of a natural progression. However, they will call it accounts receivable net. But I wanted to show this to you, and I think I did this on a previous video. And of course, this doesn't have it. Just give me a moment. Okay. So as we look at this right here, the way that they're describing accounts receivable, and this is for Meta platforms before when they were known as Facebook, they basically say, well, this 6.4 billion and this 7.5 billion are less 216 million and 229 million. So this is essentially, this number reflects these amounts having been reduced from the gross amount. And if we look over here, we basically just see accounts receivable net. So obviously they're now going through and changing it. They don't feel the need to go through and show the allowance, which in all intents and purposes, everybody discloses things a little bit differently. But I think using this as an example, especially as we're beginning to learn financial accounting, is probably the better way to go. So this is really what we're kind of going through and doing is to the investor, what we're trying to show them as well. This is what we expect to go through and collect. So coming back over here to this question. So we have the following transaction. So the only two accounts I'm really going to be concerned about for this is going to be accounts receivable or AR and the allowance or the ADA, which is my allowance for doubtful accounts. So AR is equal to accounts receivable. ADA is the allowance for doubtful accounts. So these are the only two real ones I'm really concerned with. So right over here for letter A, I had 900,000 of credit sales. Well, how do I go through and show a credit sale? Well, I record revenues, if we remember coming over here and why we want to learn how to use T accounts. Basically, I've got my assets are equal to my liabilities plus my owner's equity, ERDC. I record sales revenues with a credit. So if I had a credit sale, sales revenue. And so I'm going to go ahead and show that as a credit. And for every credit, I need a debit. Well, if I had a credit sale, that means I did not collect cash. Rather, over here, I would be debiting accounts receivable. And we started business. So another kind of thing to note is that our opening balance in accounts receivable would be zero, right? So on 1/1/32, this is the first year we went through and started business. So that's why we have a zero balance. Okay. Now here it tells me I collected 627,000 of the credit sales. So over here, cash in terms of what I collected. So if I collected 627,000, that means my customers no longer owe me 900,000. So over here, we'll call this letter B. And for every credit, I need a debit. I'm collecting cash over here at 627,000. Okay. Now, I wrote off a receivable from Jayhawks Inc. Now, what's really important is when we're going through and doing a write-off, it basically means that I'm no longer going to be able to collect that account receivable. So the way I'm going to show a write-off, though, is not via debit to bad debt expense. Rather, if I'm writing off a receivable, I'm going to credit accounts receivable because I can no longer collect that amount. But for every credit, I need a debit. I do not debit bad debt expense. Bad debt expense is handled at the very, very end. But instead, I'm going to go through and debit the allowance for doubtful accounts. So pretty important distinction there. But again, as you're going through and doing these problems, hopefully it's going to get easier and easier. Lastly, it says that 20% of my accounts receivable, I'm estimating that 20% of my accounts receivable would not be collected. So what I need to do right now is I need to figure out, coming right over here, how much accounts receivable did I had at the end of the year on 12/31/32? Well, I had credit sales of 900,000. I had collections of 627. I wrote off receivables of 30. So my ending balance in accounts receivable is going to be 243,000. So right over here, that is going to be my ending accounts receivable balance. Now, when it comes over here to what is the amount that I'm expecting not to collect? Well, it says I'm estimating that I will not be able to collect 20%. So what we're going to do is we're going to take 243,000 times 0.2. And this is going to give me 48,600. Now, when it comes to this, what exactly does this mean? Well, on my balance sheet, I'm going to show accounts receivable of 243 less The allowance for doubtful accounts is going to basically give me accounts receivable net. So 194, 400, right? And really, when I see this over here, I'm really asking for the ending, like the gross balance, not the ending basically balance here, especially since I'm asking for the ADA. So right over here, my ending allowance for doubtful accounts is going to be 48,600. Now, bad debt expense. What exactly is that? It's whatever I need in order to go through and to balance my accounts. So we started business this year. Now I need an amount here in which to balance. So what value minus 30,000 equals 48.6? I can't just write 48.6 here because 48.6 minus 30 is 18.6, and that does not work. So I'm going to take X minus 30,000 equals 48,600, right? So obviously, this is the end result. I've got to figure out how much I need to record for bad debt expense. So this is going to be X equals 48,600 plus 30,000. So my X, or my bad debt expense, what I need to balance, is going to be 78,600. So we're going to go ahead and put 78,600 here. And when I do this, really what I want to make sure is like, okay, did I do this correctly? 0 plus 78.6 minus 30,000 gives me 48.6. I want to make sure I'm doing that part correctly. So that's how we go through and get through this part. So now our bad debt expense, the way I record bad debt expense, if you've been watching the other videos, bad debt expenses are going to have debit balances, right? We debit expenses. I'm going to be debiting bad debt expense, crediting the allowance for doubtful accounts to record, not being asked for this, bad debt expense. So again, the bad debt expense is the very last step you're going to go through and do in terms of answering these questions. So we'll go ahead and give ourselves a little bit more room. And now let's go ahead and go down to the next period of time. Okay. So if I go down over here to the next period of time, right? So I've got, go ahead and just zero out all these ones here. So the cash balance, I could come through and carry that forward, although it's not really important. What is going to be more important are these two balances, meaning that my ending basically accounts receivable balance, or 12/31/32, becomes my beginning balance on 1/1/33. My ending balance for the allowance for doubtful accounts of 48,600 becomes my beginning balance as of 1/1/33. My sales revenue, this would have been closed out to dividends, or I mean, closed out to retained earnings. We also close out dividends, but not to sales revenue. So this would be starting out fresh at 0. I could carry down cash. Why not? We don't have to do this because it's not really relevant to any of our questions, but let's just have some fun anyways. And coming over here, 1/1/33. And if I really wanted to be particular, I could also put in here bad debt expense from our last one of 78.6. Now, expenses, revenues, and dividends get closed out to 0. So this is also going to get zeroed out. It's going to be closed out to retained earnings. Okay. So going here to 2033. I had 1 million of credit sales, right? This is not cash sales, but these are sales on credit. So letter E is going to be 1 million. Okay. And for every debit, I need a credit. I'm going to go ahead and credit sales revenue, right? So this is for letter E. Okay. Now, I collected 700,000 of the 2023 credit sales. Okay, collection, basically when I collect money, I'm going to go over here, FG. I collected 700,000 of the 2033 credit sales. Okay, so this is going to be F. And then I collected 200,000 of those old credit sales from before. So right over here, 200,000. It's the same thing. It's just more cash that's going through and being collected. Now, I wrote off a $40,000 receivable from Commodores. Okay, so the good thing about what we're going to be going through and doing here is we're going to see very much kind of the same types of transactions are going to definitely repeat themselves. When I write off a receivable, I'm going to go ahead and credit accounts receivable. So I'm going to credit my accounts receivable because I am writing this off. And then over here, I'm going to be debiting the allowance for doubtful accounts for $40,000, right? So when I write off a receivable, I have to credit the AR, I debit allowance for doubtful accounts. I do not touch bad debt expense until the very end of the period. So that's letter H. Now, for letter I collect 45% of the receivable that had been written off in 2032. What does that mean? Well, sometimes when we write off receivable, miracles will happen. I'll never forget when I was teaching my very first accounting class and a person whose father operated, whose family operated some vending food trucks, they actually had somebody come in 5 years later and said, my religion told me I felt guilty. I need to pay you your money. That's my favorite religion, right? So you're owning up to your obligations. So in that case, that can actually happen. So you've written off a receivable and then someone comes back and you collect it. When I collect a receivable that I have previously written off, I have to do a few steps. The first thing I have to do is to restore the receivable or reverse the curse, right? So when we go through and do that, unfortunately, I'm not sure if the Los Angeles Angels of Anaheim or the Anaheim Angels or the California Angels will never be able to reverse their curse, but you never know. Who knows? Okay. So to restore the receivable, I'm basically going to reverse out this entry here. So I'm going to restore the receivable because before I debited allowance for doubtful accounts and I credited AR. So here I'm going to debit accounts receivable. I'm going to credit the allowance for doubtful accounts. Now the dollar amount I'm going to do this for is it says that 45% of what I wrote off here was collected. So this is going to be 30,000 or what I wrote off times 45%, right? So this is 30,000 times 45%, right? So of the JI receivable, that's right up here, I collected 45% of it. So I credit the allowance for doubtful accounts. So the first thing I'm doing is I am restoring the receivable. So this is going to be letter I, and I am crediting the allowance for doubtful accounts, or over here, letter I. Now, if I'm collecting it, I have to show the cash coming through. So I'm going to debit cash and I'm going to credit accounts receivable. So I have to reverse the curse, meaning that I've got to restore that receivable. Then I'm going to collect the receivable. Okay, so I have to go through and do those two steps to record a receivable previously written off. So that's what I have to go through and do. So over here, I'm now going to basically credit accounts receivable for 13.5, and I would go through and debit cash for the same amount because I've gone through and collected it. So, and I I know that some of these steps for you, you might say, "Oh, dude, I've got a fantastic shortcut. That's great." I'm showing you the longer way for a particular reason because I want to make sure that you're really understanding where all these numbers are truly coming from. And then that way, as you're practicing and you're kind of moving forward, you'll be able to perform that much better on exams because you'll understand it better. Okay. So I've collected that over here. Now, here it says I'm estimating that 25% of my ending AR balance will not be collected. So similar to what I did last year, I'm going to basically say, okay, what's in my AR account? Well, I have the 243 beginning million of credit sales, reverse the curse. I had to restore that AR. So 1,256,500. Now less collections of 700, collected 200,000, collected 40, and then I collected the 13.5. So over here, my ending balance and accounts receivable is 303,000. So because of this, right, because I go over here of 303, the ending balance of my allowance for doubtful accounts is going to be 303,000 times 25%. Remember, I'm going through and I'm basically saying here that, well, my AR balance is 303 less my ADA or 75, 750. Remember, this is a contra asset account. It is reducing the carrying amount of our receivables. So my net carrying value is going to be 227, 250. So now I come over here to my allowance for doubtful accounts and I'm looking at this T account. Does 48.6 plus 13.5 minus 40 equals 75,750? And the answer to that is no. So what I need to do is to figure out how much do I need to credit the allowance for doubtful accounts for. So this is going to be 48,600 plus 13.5 plus Y minus 40,000 equals 75,750. Okay. So if I say, okay, so 62.1. Okay, so if I simplify this, this is going to be 22,100 plus Y equals 75,750. Let me just check that one more time. 48,600 plus 13.5 minus 40,000, 22,100. Perfect. Now, if I isolate Y, Y is going to be equal to 75,750 minus 22,100 or 53,650. So right over here, I'm crediting my allowance for doubtful accounts for 53,650. For every credit, I need a debit. This is what I'm debiting to bad debt expense. We do bad debt expense very, very last. It's the last thing we go through and do. So that's what I'm going through and doing. So my ending AR balance was 303. My ending allowance for doubtful accounts is 75,750. And my bad debt expense for the year ended would be 53,650. Okay, let's go through and do yet another time period. And we'll just bring down these accounts this time. Okay. Okay. So coming back over here, right? So going back over here to AR. So this was my 12/31/33 balance. Okay. My cash over here, which I'm just doing this for fun. Okay. My sales revenue and my bad debt expense, those would have both been closed out to zero, right? Because revenues, expenses, and dividends, we close all of those out to zero. Okay, so coming over here, my beginning balance on 1/1/34 would be my ending balance as of 12/31/33. My beginning balance for my allowance for doubtful accounts, which has a credit balance because it is a contra asset account, is going to be 75,750. My cash for fun has a beginning balance of 1,540,500. How perfect, a place where we don't have to pay anybody in terms of sales. Okay, so during 2034, I had the following transactions. Okay, so 2 million of credit sales. So need to record sales revenue. So 2 million. Okay, so debit AR, credit sales revenue. That's letter K. I collect 1.2 million of the 2034 sales revenue. So we've got L, M, and N. So we've got 1.2 million. We've got 100,000, and then we have 22,000. So I'm for all these items over here, L, M, and N. It's basically the same thing. I'm debiting cash, crediting accounts receivable. Okay, so that's L, M, and N, same transaction. Now I'm writing off a receivable for 27,000. When I write off a receivable, I don't touch bad debt expense. Rather, what I'm going to do, I'm no longer going to collect it. So over here, I'm basically going to I'm going to credit accounts receivable for the write-off for 27,000. And then I'm going to debit my allowance for doubtful accounts for 27,000. That's how I go through and do on that one. Okay, now over here, we have a couple of different, we're collecting some of the receivables that were previously written off. It's the same journal entry. I've got to restore that receivable, reverse the curse, basically to write it off. I credited AR, debited the allowance for doubtful accounts. I'm basically doing the opposite here. So for letter P, so this tells me I collected 10% of the receivable that had been written off in 2032. Well, the amount of the receivable I wrote off was 30 grand, so I'm now collecting 3,000 of that, or 10%. When I go through and do this, I'm going to debit accounts receivable. I have to restore the receivable. I come up here to my allowance for doubtful accounts. I am restoring the receivable. Then I have to show the receivable being collected. I'm going to credit AR, and then I'm going to debit cash for that 3,000. Now coming over here, I collected 70% of the receivable that I had written off previously in 2033. Well, how much should I write off in 2033? Well, I wrote off 40,000. So over here for the letter Q, basically this is going to be, just finish this one up for P. This is going to be 40,000, or the write-off times 70%, or 28,000. So coming over here. Okay. So these journal entries, obviously missing the dates, that kind of stuff, but it's really just more to kind of get you used to in terms of how to go through and record these different items. Okay. So for letter Q, got to do the same thing. Got to restore that receivable. So this is going to be for 28,000. And this is going to be for 28,000. I have to then show the receivable being collected for 28,000. Okay, so that's all I have to go through and do. Now for this last part, I'm done with the transactions. I'm now ready to go through and basically say, okay, what is my ending balance, right? So I'm estimating that basically I have to find out my ending AR balance. How do I do that? Well, I look at my beginning balance, my credit sales during the year, and then collections of prior accounts receivable written off, my cash collections, and then showing over here basically when I've gone through and I've collected or I've had a write-off and then I'm collecting AR that was previously written off. So the ending balance in my accounts receivable is going to be 954,000. Now, my ending allowance for doubtful accounts balance, how do I figure that out? Well, coming over here, right? So, kind of did that wrong. Hold on. The ending balance in my allowance for doubtful accounts is going to be 30% of 954 or 286,200, right? I figure this out first. My ending ADA balance or my allowance for doubtful accounts is going to be 286,200. If I say in this here, I might say, oh, is it a debit or a credit? So this would be a credit balance. This would be a debit balance. So if I ask for that, just make sure you indicate it. So lastly, we have to kind of go through and see over here. We're left with a similar issue to our previous problems, which is this T account in balance? Now, if you're taking my class, it never will be. So maybe in some fantasy land, it may become, but not for me. So does 75, 750 plus 3 plus 28 minus 27 equals 286? And that answer is no. So what I need to do, 775, 750 plus 3,000 plus 28,000 plus Z minus 27,000 equals 286, 200. So basically that means we have 79,750 plus Z equals 286, 200. So Z is going to be equal to 286, 200 minus 79, 750, or 206, 450. So 206, 450 is the amount of my bad debt expense. Remember, bad debt expense, sales revenue, these are going to have zero balances at the beginning of each year because they are expenses and revenues. And those, along with dividends, are all closed out to retained earnings. So now, really important, what I want to go through and do is that, does my math work? Let's check. 75, 750 plus 3,000 plus 28,000 plus 206, 450 minus 27 equals 286, 200. So I've done that part of the question correctly. So my bad debt expense is going to be over here, a debit of 206, 450. So hopefully you've enjoyed this series. If you're looking for anything more that's basic financial accounting in terms of accounts receivable, feel free to leave a comment below. The one thing I do want to kind of just briefly mention over here is that in accounts receivable, we've looked at a few different ways to kind of go through and compute it. One of the ways we went through and looked at it is essentially through an aging of accounts receivable. And with this, for this question we just did, we basically said, okay, this times 30% is my ending allowance for doubtful accounts balance. But with this one over here, we basically said, okay, we've got to take the receivables, break it down into components, and then say what percentage are we not collecting on each round. So that's what we're kind of going through and doing. This is giving our ending balance and the allowance for doubtful accounts. There is a third method that you may get exposed to, which I do not teach because when I ran into someone from the FASB, probably in the last 8 years, is something called a percentage of credit sales. And the reason why this is somewhat of a problem is that this basically says, okay, you record bad debt expense basically as, you would say, okay, well, we're going to have basically our net credit sales, right? So say if we had credit sales of like $1 million, We collected, we estimated our bad debt expense to be 5% of net credit sales. Of the credit sales, approximately 400,000 was collected during the year. Okay, so let's just go through and kind of have fun with this question. So when we look at this over here, and this is why I'm going to tell you not to do this type of question. But if we had credit sales of $1 million, so I would basically go through debit accounts receivable, and then I would be crediting net credit sales for that amount, right? So I have my AR net credit sales. My bad debt expense is basically going to be 5% of net credit sales, or 50,000. And so my allowance for doubtful accounts, I would debit bad debt expense, credit the allowance for doubtful accounts, and then I would get this amount over here. Now it tells me that I collect 400,000. Okay, so over here, cash is 400,000. And that means over here, I am going through and basically collecting 400. And when I look at this here, my ending AR balance is going to be 600. So I've got AR less the allowance for doubtful accounts gives me accounts receivable net. Okay, so my AR is 600. My ADA is 50. And then over here, I've got accounts receivable net of 550. The reason why I don't like this is when we're looking at the balance sheet, we have to be able to say, do our assets represent our future economic benefit? If I'm using this methodology, and it may work for some businesses, but if I'm using this methodology, this is an income statement approach. This is not a balance sheet approach. What I'm really more concerned about is are my assets over or understated? Have I gone through and looked at the accounts receivable at year end and made sure that this looks okay? So when you see this percentage of credit sales methodology, this is why I don't teach it. And the reason is because really with accounts receivable, obviously the best way to go is to look at an aging, because as time goes on, the less likely of collection. So, and if we take this approach and then basically kind of back our way into bad debt expense, this is really for the investor looking at the balance sheet. In my opinion, this is by far the best way to go, is to take a balance sheet approach and not the percentage of credit sales. However, you'll still see this in textbooks. I think I ran into someone from the FASB or some other regulatory agency. And when I ran into those people, I'm always asking these kind of random questions like, have you ever seen some of the year's digits? And I'll know, well, they say, yeah, but it wasn't described that way. And I've looked at 10,000 SEC filings. So when I asked somebody about this is kind of what they shared with me. So this is why I don't teach this stuff in, my classes. So if you do and you have a question about it, feel free to send me a question and I can help you out. But in any event, thanks for joining me here today. I look forward to seeing you on future videos and have a great one.